Hey guys, welcome back to Average Joe Real Estate Investing. So I had a couple people reach out and ask about the different mortgage options that I was offered on my primary lake house. When I first bought it, I was a first-time home buyer, and I was offered an FHA and a conventional loan mortgage, and they're both by a credit union, and a little bit different down payments and percents. So first off, I use this website called mortgagecalculator.org, and in my opinion, it's probably the best option for mortgage calculators. And there's a couple cool things. It's really laid out nice, and so if you look, just going down these tabs, I mean, it's super simple to fill in. And then if you get down here, you can hit the share calculation, and you just highlight this tab, copy it, and then you can send it to your husband, wife, or your family member, or friend, whatever it is, and they just put in the tab up here, hit enter, and it'll pull in all this same information. So it's nice to be able to just quickly show your spouse, like what your monthly payment's going to be, and then what your down payment is. Just something nice for them to look at, easy to shoot over. So either way, first option, FHA loan. And so that was 3.5% down, 4.25% interest rate, 0 PMI. And so even though FHA loans don't have PMI, they just work it into the interest rate. And I'd say the bad thing about that is you can never get it dropped off. It's always there unless you refinance. So I'd say that's the negative. The good thing is you can enter at 3.5% down, which is very low. So the conventional loan was 10% down, 3.875%, and then there was $85 of PMI, which on this calculator equaled out to 0.5%. But that was the number. And so if we go back to the payments, the FHA loan would be $1,460 a month, and that's escrowed, so with your taxes and insurance included. And you'd pay about $170,000 in interest over the life of the loan, no extra payments, of course, and then you put almost $8,000 down. So pretty low entry. The other one was the conventional loan. That's about $1,430 a month, $22,500 down. So that's what, 3 times as much the amount of the FHA loan, almost. And then 140,000 total interest paid. So 30,000 less interest paid, but a lot more money up front. So, So the reason that I went with the FHA loan is the conventional loan would have taken all the money I had in my savings account, and I would have had nothing left over. And I knew I was going to have a bunch of dead trees taken down. There's a bunch of maintenance I was going to have to do, deferred maintenance. And then you're just moving into your first house. You want to have a cushion. You never know if you're going to get laid off, something like that. So I wanted to go in having a big savings. So if you take $22,500, which is roughly about what I had in my bank account, and then you minus the $7,875 from it, I had an extra $14,625 in my account doing it this way, using the FHA loan. And so if you divide that by the monthly payment, I had 10 months worth of mortgage payments sitting there. And to me, that feels really safe. They always say to have 3 to 6 months of total expenses. So if I factored it out, that's probably what I had left over is 6 months worth of expenses. And so that's why I went with the FHA loan. The total interest paid really didn't scare me a whole lot that I was paying more of it. It's such a low interest rate compared to historic rates anyways. And then also money now is always worth more than money later, with like inflation and just your opportunity. So I want to keep money on hand. So I took the FHA loan with 4.25%. So on the conventional loan, just to talk about PMI real quick, so there's this $85 worth of PMI. The advantage of this loan would have been that after 67 months without paying any extra, the PMI would have got dropped off automatically. The market was going up quite a bit at the time too, so another option you can do is just have it reappraised a year later. I believe you have to wait a full year, at least you do at our local credit union. And you can have it reappraised for a higher amount, and then if your loan amount is less than 80% of the value, then you can also put in a request to have your PMI removed. So technically, with as much as the market was going up, I could have got rid of the PMI probably within a year on this property with all the equity I had in it. So that's two ways to think of it. My credit score was 740, and I just went to this credit union. I think I checked out one other one, but I didn't try banks or whatever because you can get a conventional loan with 5% down pretty easily, probably even less. But I liked working with this company, and that's why I chose them. But either way, so I went with the FHA loan just because of the low entry point. So then, so the market continues to keep going up. COVID hits, and interest rates plunge even further. And so I was like, yeah, I might live here for a while. I don't quite know yet. And so I refinanced. It cost me $900. I was able to get a higher appraisal as well. Um, and so yeah, that's what this would look like then. Is my PMI dropped down to $54. This wouldn't technically be right because my loan was a little lower at that point. But either way, it was $54, and my payment was just under $1,400 then. So I went from 1460 to 1390, and it only cost me $900, and I still got to enter at the $7,875. So I have money in my savings, and now my mortgage is lower than both those payments. So sometimes I guess it pays to wait, but I refinanced into a conventional mortgage. I had PMI that eventually I would get to drop off. I had 90% loan to value, so I had to pay off another 10%. And I'd be able to put in a request to get it dropped off. And then the interest rate at that time then was 3.25. And I mean, that's you're probably never getting lower than that, especially in the future, I would think. And so at this point, the total interest I would pay over the life of the loan would be $123,000, so also less. So for me, it made sense, low entry, and then just refinance. I just kind of got lucky with the way the interest rates went. The market kept going up, so I got the higher appraisal. So things like that. And so the way I decided if I was going to refinance was based on the cost. And so I checked around, and a few places wanted between 3 and 5,000. It still probably would have made sense, but I was like, man, that's a lot of money if I'm not going to stay here. However, like I said, I found this one credit union. They were offering to refinance for $900 just to get people to come to their branch. And so there's this calculator that I use quite a bit, and it's the break even calculator for refinancing. And so you type in all your original loan terms, your new loan terms, and then the cost right here of closing. You can also do it up here, and then you have to figure out math. But I just knew the total, so I put it right here. And it took me 7 months to break even. And so I was like, man, even if I don't stay here a couple, like if you move 3 months later, you're out $450. And so it was a no-brainer for me to do it because this calculator just showed me in 7 months I will then have my money returned to me, and then after that it's just all profit from there. For the same property, there's nothing different, just a little extra paperwork. And so that's on the bank rate website, and it's the mortgage refinance break-even calculator. So check that out. Probably won't need it for a while because rates are not getting better. So anywho, I made this little list then, and so this kind of just breaks down exactly how I got my money out of the property and what I spent into it, I guess. So the down payment was $78.75, and that's 3.5% down because I did the FHA loan. The seller paid closing costs, so I didn't have any other fees. That's literally the check that I wrote to the bank. Um, so then right afterwards, I had a bunch of dead trees, which I factored into having to do when I purchased the property. I knew that they were immediately going to have to get taken down because they're dead, huge, right right next to the house. And so that was $4,500 immediately. Um, and then throughout the whole time that me and Caitlin lived there, we spent about another 5 grand that I added up. That's just in building materials. We hired a couple contractors to like extend the driveway and stuff like that. Built a cool dock thing, did a bunch of landscaping, etc. I refinanced, so I counted that as an expense. It's money out of pocket. And so my total cost for living there for 2 years, minus obviously the mortgage payment, but all the maintenance and down payment is $18,275. I didn't include the mortgage payment because you have to live somewhere, and rent in our area for a place that's equivalent to that would be about $1,300. So relatively the same as what I was paying for a mortgage. And so, anyway, so I'm about 18,000 into the property total at this point out of my own pocket. I paid 225 for the property. There's the again from up here the amount of money that I'm into the property, and I sold it for 330,000. I just looked up and verified, made sure I wasn't remembering incorrectly, and that was for sale by owner, no realtor fees, and the buyer paid all the closing costs. So the exact opposite of what I did the first time. So I pushed those payments off to him. And so if you do the math, the tax-free profit, because it was my primary residence for 2 years, so my profit, which is the check that I got minus this amount, was $101,725. And so off from 18,000 in 2 years, I made 101,000 while living on the lake, fishing, enjoying life a little bit. And so that's pretty cool. And so the check the day of closing, I think in the last video I said 115. Looked it up, we got 120,000, which is even a little cooler. But that's like with a little bit of mortgage pay down. That's all these costs work back into there because like I already put that money into the property. That still is coming back to me. And if you do the math on, I can show you the calculator I used for this, but the total return on my money in 2 years' time is 556%. And that's using this number as an upfront cost, and then you're getting that check back at the end. And so there's this calculator I use for that, which is pretty sweet. It's just calculator.net. They have all sorts of cool calculators. But either way, just upfront cost, return, and then I just did how long it was. Obviously, those aren't the real dates. But here is there's my ROI, which is crazy. What else can you get 556% tax-free money? Just crazy. But yeah, that's my story on that property. I got offered 2 loans, which I thought was pretty low. I figured they'd have a bunch of options, and that was a 740 credit score. They made it sound like between 680 and 740, there's not a ton of difference. So I wouldn't get hung up too much on your credit score. I think if you're in the high sixes, low sevens, you're doing just fine for a mortgage. I would do an FHA 3.5% down. I think money now is worth more than money later. If you factor in inflation, missed opportunities, all of that stuff, that 30,000 difference in interest paid really doesn't matter if you're planning on investing. If you're planning on just living in your house forever, working a normal W-2 job, well then maybe you care about how low can you get that interest, how fast can you pay off it. But that's my video. That's all I got for you, and have a good day. Get some of that cash flow.